this is also a vitally important discussion. I mean, everybody in the end wants to know what are the stocks and sectors and themes that are going to make money, right? And where do you invest, whether you're a stock investor or a fund investor. And I think one thing is really settled, which is, again, a message that has been going out from almost all fund managers, at least over the last 1 year, that, the markets are getting tougher. The alpha opportunities are reducing. And the post-COVID phase, the first 3 to 4 years that we saw of very solid returns is not going to be replicated. We'll have to focus on stock specifics, fundamentals, pockets, and even within sectors, you have to be very choosy about which stocks you invest in. That is settled. But the interesting thing about the 4 gentlemen out here and why I'm excited about the panel is each one has a slightly different style of investing. They're postured differently. They have, therefore their views can be quite different. And we'll try to assimilate their views and their logic so everyone can take away whatever they are most convinced about. So thank you so much, gentlemen. So the first question is, there are 3 broad categories in markets, the way we've understood it: the consumption theme, the investment theme, the China plus 1 theme. But today we can talk about all 3. But the big question that people have been asking is that, is a consumption revival, is consumption going to lead the charge in the next round? Is that where we are going to make our money? Because investment phase has sort of done the heavy lifting over the last, in the post-COVID period, especially because we were in an investment upcycle also triggered by huge spending by the government. Is that, in a sense, likely to get swapped in this phase? Shridatta.
Good evening, everyone. I think it's an interesting question. Most of the time we try to answer questions in black and white. My answer is in between, actually. It's going to be barbell. That's how we are looking at it. But having said this, on this barbell, I think both sides, whether it is investment side or consumption side, there are certain clear-cut trends that are visible. And as you rightly said, and I largely concur with that if you look at not only last actually 4 years, but if you take last 10 years, effectively, predominant focus both from central and state governments and then real estate joined the party, which are the 3 critical components of capex, have been on the positive side. In fact, the growth in these 3 categories, if you take 5 years, has been upwards of 13-14% CAGR. Even if you take 10 years, it's actually roughly 10-11%, which is a little bit higher than nominal GDP growth rate. And that clearly propelled the kind of rally that you have seen on the investment side, because to start with, they had gone through the underperformance of the entire last decade, because balance sheet, we started the last decade with leverage. And that's where there were a lot of challenges, both on banking and manufacturing side. And as you came out of that, you got both the earnings re-rating, driven by all 3 components. And in fact, private capex was also healthy for 2 years, calendar year 22 and 23 particularly. All 4 components were firing. And so you got a growth which was clearly above average. Now, having said this, does it mean that you're likely to see a substantial slowdown? Our sense is it is just going to be moderation. And incrementally on investment side, clearly you have to actually opt for pockets where either for geopolitical reason, which is some of the defense, aerospace, and some of the areas where probably opportunities will continue to expand. So you have to continue to look at them, not necessarily the same stocks, same spaces, but that one you have to continue to look at. Clearly transmission and distribution is a space which you have to continue to look at, given how the power sector dynamics is changing. You would also continue to look at renewable power itself. Now, you can choose, pick and choose the part of the value chain that you want to play, but you have to continue to look at. So, incrementally, yes, the margin of safety on the investment side has gone down. Incrementally, there is a moderation, except for private capex, which we are expecting that at some point in time will kick in. But clearly, public capex has kind of plateaued, mostly probably run at 8 to 10% CAGR over next 2-3 years. And when I look at all these 3 things, on the investment side, clearly we would want to be placed in a space where the profit pools are expanding. and there is a high visibility. And those are the three spaces where I clearly see that, okay, both these criteria are getting met. So that's the investment part. When I actually start looking at the consumption side, I think clearly, when you again look at what are the key drivers for consumption, actually the key two drivers for consumption fundamentally are, of course, one is job growth rate, wage growth, and third is, whether we like it or not, again, Indian basically economy is structured in such a way that again governments play a very, very critical role. I'll again step back and say, when you look at the revenue expenditure of state central government put together versus the capital expenditure of state central put together, this regime over last 10 years has chosen predominantly the investment side or fixing the supply side versus the consumption side. And that's where the revenue expenditure generally has been lower, which has also been one of the factors apart from subpar job growth, which has led to mass consumption. Again, when we talk about consumption, it's the mass consumption which has suffered, not the luxury consumption. Our sense is, incrementally, the redistribution of government resources has started tweaking towards the basically mass consumption, towards the revenue expenditure. If I have to quote the few, the social schemes put together, state governments 3.2 lakh crore rupees, central government tax cut of effectively 1 lakh crore rupees. You have GST cess, which will go out, the obligation will go out in 2027, which will be available money for central government to spend towards consumption, the liquidity, the interest rate cuts. So when I actually combine, and wealth effect through gold, when I combine a lot of these factors, and when I look at the expectations on consumption side, particularly mass consumption, I'm again and again actually addressing that point. In terms of the statistical valuation might be a little expensive, but from an expectation perspective, from a margin of safety perspective, I think that piece, if one were to find the right niches, would probably give you better outcomes over 3 years. That's how we are looking at it. So that's a long answer to your short question.
Yeah. You between the consumption and investment space, you still think that the consumption space will outdo the investment space?
No, how we are thinking about it is that the investment space will moderate. There are basically clearly relatively higher valuations, higher margin expectations. So margin of safety is lower. So you have to be clear in terms of what part of the investment theme you are playing incrementally.
You said some of them like defense.
Whereas in consumption, I think low ticket consumption, there will be a lot of opportunities from a 3-year perspective. I'm not talking about 1 or 2 quarters, but there will be a lot of opportunities from a 3-year perspective on that side.
Okay. You concur with that, Ashish, broadly?
Yeah, the only thing I'll kind of have a slightly different view is I think the margin of safety actually even in a lot of consumption names is very low, right? And unfortunately, what we have seen is that while consumer demand has been low and a lot of consumer companies have disappointed in terms of volume growth and top line growth, we haven't seen a margin collapse, right? So when the recovery happens, we will only get better top line growth driven recovery. We will not really have a margin expansion.
Right.
And when we look at any kind of big re-rating story, right? So there are 3 components. One is top line growth coming back. Second is with top line growth, operating leverage kicks in and your profit grows faster than top line. And on third count, you see a valuation re-rating, right? On the consumption side, I think the latter 2 are missing this time around. Because while top line growth has slowed, margins are still high, and actually multiples are still not cheap, right? So we have not seen absolute de-rating. Yes, they would have underperformed a lot of the investments side stocks, but absolute multiples of most consumption names are as pricey as they were, right? So that's the only difference I will have.
Sure. You concur with that, Neelesh?
Yeah, if I have to maybe take a near-term view and longer-term view. See, I concur that on the investment side, I think at an aggregate level, it's a very peculiar market in my opinion, where we're not seeing anything which is very cheap. And there are certain pockets which are slightly on the expensive side, and most of them happen to be in the, let's say, investment-oriented businesses. Post-COVID, we have seen, massive thrust on at a top-down level. If you look at it, the investment in the has grown at around 15-18%, and it's literally the budgets have tripled in last 8 years. But if you see the so-called narrative businesses where there is a valuation fraud, be it defense, EMS, capital goods, etc., they are mostly on the investment side. So I'll be slightly cautious that good theme, good narratives need not be good investment, because you have to look at the valuation part. On consumption also, well, the valuations are, some pockets are expensive, but I think from a near-term perspective, let's say next couple of years, not in a medium-term perspective, there should be mean reversion in the bottom of the pyramid or the mass consumption on discretionary side for multiple factors. Rural income, the rural incomes are good. RBI has done very prudent, decisive, and timely action of injecting massive liquidity, so the interest rate easing, faster transmission is happening. We have next year pay commission sort of coming in, income tax sort of is coming in. Also, the stress in the system has been there for last 4-5 years because of inflation, so that could happen. Longer term, of course, consumption is a very powerful theme, again, subject to valuation of the stocks, because if the narrative is the country per capita will increase, then obviously the scope to increase the discretionary consumption is massive if you increase from $2,500 per capita to whatever middle income economy. The challenge is that you have to juxtapose and see the valuation part also. Right. But between the two, I would say that consumption appears much more sort of reasonable. But Mahalakshmi, the thing is like both investment consumption are very generic things. I mean, there's so many underlying businesses, yes, so many cohorts that you have to slice and dice and look at more bottom-up thing. For example, the mass consumption, where the earnings have not happened in last 5-6 years, I think that have much more reasonable valuations than premium consumption or leisure and some of those stocks which have done well in the last 4-5 years.
But do you see triggers for mass consumption to really kick off now? Because somehow in most of the spaces, you know, it's every quarter it's a different story. You know, first 4 quarters you say, okay, this pocket of urban consumers not doing well.
Yeah, no, so the corporate commentary still is not showing too much of results on the ground, but I think the top-down triggers are very, very strong. You look at RBI action, and it's massive interest rate easing, macro-prudential norms are getting reversed, liquidity injection. Rural is recovered. I mean, we are seeing one of the best crops. And let's say if this monsoon is okay, you will have more confidence. The impact of inflation is coming down on the rural side. And then you have the income tax thing. There is a wealth effect of gold. And also maybe pay commission is also a large number next year. So I think the theme is there, but you're right, that is yet to happen. What most people, most economies are saying that, particularly from the interest rate easing, etc., you'll see next couple of quarters things should sort of stabilize. So you're right that today there is no buoyancy, and also the fact is that many of these categories, they are not saturated, but they have suffered. Let's say the passenger vehicle entry segment is lower than what this whole 6 years back.
Yeah.
So that has been the pace of slowdown in that mass bottom of the pyramid. So I think over time, because they are not structural degrowth sort of story, it should recover. Hopefully over the next year or so, at least signs should happen. And by the way, lastly, we're not talking of very high growth. What we are talking of literally Maruti type growing 1% to 6-7% volume numbers. Right.
Right. Rajeev, how much of this consumption issue, I mean, there are 2-3 parts to it. One is there a structural issue? Is that what is keeping consumption down? And all these factors like liquidity, etc., does it really alter that? Your take on that? I think that's a larger question that we need to answer, because especially since Neelesh said it is a structural story, but is it truly a structural story?
Let me throw a googly here. Let me argue that there is no consumption slowdown. Okay. For each order, which is order for a biryani placed on a food delivery app, a 2-minute instant noodle does not sell. For each D2C shoe pair that is sold, the listed shoe company does not make a sale. Right? For each streaming media subscription, a footfall does not happen into a theater. So Rama Bijapurkar many years back wrote this book that multinational cornflakes sellers came starry-eyed into India saying we'll, a billion plus population, we'll sell them tons of cornflakes. But culturally we want idli, parathas and upma. Cornflakes never sold in India. But today when all your gambling apps are selling, when there are instant sales of high-priced concert tickets and which sell on black later on when IPL tickets are selling out. It's a problem of the Bollywood movie makers and the multiplex players in terms of getting the value equation right and selling the right product. I think whether investment or whether consumption, when India's GDP is growing, it's growing in both ends. It's a problem of the individual company and the market dynamics that their product is not selling and their P&L is not showing. What we are focusing on is there pricing power? What is happening to competitive intensity? Will profitability come with volume growth? A big box retailer, a well-known name, well-run company, March 25 quarter showed a volume growth of 14% or 17%, somewhere thereabouts. PAT declined 4%.
Yeah.
Why is that happening? Because everyone wants to be your grocer. There are maybe 7, 8, 10 players wanting 10-minute grocery delivery. There are 5 big box retailers and the Kirana players have not gone away. So we are focusing on spaces where either there is stable competition or the number of players are coming down. That is where we are finding opportunities. Sector after sector, lot of wealth destruction is happening purely on account of increased competition. Obviously, at the company level, you will not see the growth.
So as a stock market opportunity, you don't see the consumption pack as an alpha generator?
I see alpha generation in both investment and consumption. It depends on the company. Neelesh mentioned there are a lot of nuances and subsectors. I would focus on subsectors rather than making these macro calls.
Fair enough. So let's deep a little diver. So you said in the investment space, you called out, I think, power, defense are some of the sectors that will expand. Are you not worried about valuations there? Because especially defense stocks, I mean, the market's quite divided. I think 1 year back we were saying that they were really expensive. Today, I don't know what to say.
No, so ultimately, like my other colleagues also said, it boils down to the individual segments, okay? And that's where when you look at the investment side, and yes, all of us are micro fund managers, so we start bottom up, but we do look at time to time, top down, little bit of digression, but just to give you history. If you actually step back and think about last 20 years, when did you get the biggest capex cycle in India? When did you get the biggest consumption cycle in India? And I'm not saying even in that consumption cycle, every company or every sub-segment or segment did well, but there has to be a top-down driver in place, or you need to have huge job creation in the economy, which again points to growth. When those are not there, clearly then you have to go bottom-up. But coming to your question back in terms of these 3 segments, yes, we are worried about the valuation. But at the same time, we are also looking at the opportunity and how the opportunity pie is expanding in this segment. And within that, then which pie you want to capture, where the margin of safety is relatively higher, who, like Raju said, who are the guys who have clear-cut competitive advantage in a sub-segment, can somebody else come and disrupt them or not? Those are the segments you want to play. So even when you are talking about, say, a defense or a power or a T&D value chain, which is again extension, renewable power and basically the T&D space, you're talking about the B2B businesses, but where clearly there is some form of technological advantages or there is some form of regulatory advantages, because of which the expanding pie of opportunity that is presented on a top-down basis, you are the guys who are going to capture it more. But yes, the valuations will mean that your implied returns have to be lower. And that's true for I think, largely the entire investment basket. Not only these 3 spaces, but the entire investment basket. So that's how we are looking at that.
So in both these spaces, are there any sub-segments that you're super excited about, which are depressed and can give you significantly higher returns, where you're most bullish, and also the
No,
lows?
I think as far as the investment side is concerned, there is nothing that is depressed, okay?
In the entire market, there is
probably the only depressed space in the ancillary to investment is real estate ancillary, which is building material. That is also optical. There is a lot of disruption that is happening in those sectors. But nonetheless, that is one space that you can call out, or consumer durable, again, which is ancillary to the real estate as a capex if you want to put out. But I can't think of any space which is actually depressed, which is where I said you have to focus on, can this company deliver that 25-30% growth? For example, most of the T&D company, I think next 3-4 years, they can deliver. There is a good probability. We always work on probability. 60, 70, 80% probability that they can deliver 30% earnings growth. Same with some of the renewable value chain. But you have to be careful again, what part of the renewable value chain you want to play. Do you want to play utility, or do you want to play equipment manufacturers? Within equipment manufacturers, who's the guy who's backward integrated, who's not backward integrated? So you have to be very, very careful about what you play in some of these segments, because while they are growing at 30-40% CAGR, they're also trading at 30-40-50 p.
Correct.
And that's exactly the reason when you actually just about it with consumption, within mass consumption, except FMCG, where there are all the challenges which Ashish or Rajeev or even Neelesh alluded to, the competitive intensity, changing consumer patterns are hurting those segments. But there are a lot of sub-segments in low-ticket consumption, which is two-wheelers, low-end cars, basically rural consumption. You have basically the consumer durables, building material space. These are the parts of the consumption where the valuations, if I look at them from a 5-year perspective, they are probably down on an absolute basis or at the same level with lower margins and probably lower earnings growth, much lower earnings growth. So that's how I think that's where I said from odds perspective, probably if you can actually on a bottom-up basis find out the sub-segments on consumption side, you have higher probability to make money because your starting point is far better. And actually, again, going back to that point, if you look at India, the largest actually capex growth you got was between 6 to 12. And it was predominantly driven by the global rally, whereby your absolute growth was very high. That led to very good balance sheet. Government did actually excesses on revenue expenditure side, and that's where anywhere between 9, 10 to 13, 15, you got huge consumption rally. After that, consumption has been struggling. Okay, so at the margin, you have to have either of the two things in place. I think the absolute high nominal GDP growth rate and job creation, or you need government support. And my sense is, on a broader basis at least, we do whatever we do on bottom-up basis, but from a top-down perspective, the redistribution of tax revenues towards the consumption categories or revenue expenditure has already started. It will only get added over the next 2-3 years. That's my sense.
Fair enough. Ashish, one subsector that you are most bullish about?
So, actually, I'll go to financials. So, or you are saying from consumption or investment?
Yeah. I guess financials, all of you will pick, so I'm not asking that.
Yeah. So I think really on the investment side, I'll agree equipment manufacturers on the T&D side. I think there we clearly see both the top-down opportunity. We also see potential of limited competition. I think, yes, valuations are not really in favor, but I think there are strong moats to businesses that are in place. So I think that would be one thing.
Okay, Rajeev?
So our preference is for niche businesses where it's not worthwhile for the biggies to come and try and compete. They generally get ignored, saying too small for us to go and compete. So they let the existing incumbents live in peace and do their thing.
Okay, smaller sized consumer businesses you're saying where competition cannot disrupt.
Yes.
Okay, fair enough. Neelesh?
As I mentioned, that one has to have more diversified, not one particular segment. There are so many businesses, but as I said, near term there will be improvements, mass consumption discretionary items, and more importantly, from a very longer term lens, couple of decades lens, this makes a lot of sense because if the per capita increases, you have. All of us know the foundation of the growth of India economy is based on demographics and consumption, better dependency, you have favorable age profile, more women in the workforce, proliferation of media, all that builds up into many categories where the penetration or the headroom to grow over the next couple of decades is there. And we are in an opportunity where let's say particularly the mass consumption has been soft for last 4-5 years, and that's more, it's not structural. So I think I will just tend more towards, if the question is more on which theme, it's more towards consumption. More importantly, not only the longevity, the canvas is very wide. If you look at consumption fund, they invest in even B2C banking franchise, they can invest in hospitals, any B2C businesses. So between the two, I would more veer towards consumption. But as I said, it's subject to very valuation. A lot of Rajeev mentioned, most businesses are having competition and or disruption. So we can't say paint may be a good business, but there are other issues of competition. So one has to be very
Sure.
careful.
Today, thanks for that. Just one question which was out of syllabus, but we have to ask this today because, weekend, a lot of news flow. It'll be a big miss if we don't touch upon that. How do you look at the current geopolitical development? Is this a bigger risk than whatever we've seen over the past 2-3 years since the Russia-Ukraine? Somehow the market seemed to shrug off even this today. 500 points down on the Nifty. Doesn't look like they're really worried about crude prices or anything happens to the risk to global equities. What is your take?
I think it's anybody's case. I would rather pass that question because just after 1 hour something else might happen. So I'll just I don't think we can predict these things. What we as a portfolio managers are actually trained to do is how can we actually find out businesses, whether it is sectoral level or individual level, who can actually create basically free cash flows over a period of time and redeploy them in a good manner, or operating cash flows and redeploy them in a good manner.
And you remain fully invested?
We always remain fully invested, upwards of 90. We don't keep cash. And that's on a very, very fundamental tenet that basically investor has allocated money. We believe as a house we are fairly conservative. Right. So there is 2 legs of actually decision making that has already happened. There is no need to actually additionally create one more leg. There could always be short-term challenges, but that's okay.
Cool. Ashish, do you see?
So I would like to only submit that, there's a statement, if there's risk everywhere, then there's no risk at all, right? So what's happening does not just affect India. In fact, frankly, you can argue both ways. Some will argue India is more immune to some of these pressures. Of course, there's geopolitical trade pressure, so you can say India is more immune. We are not so externally dependent. You can also argue that because of oil, our dependence is higher. But the fact is that if I look at sum total of risk, whether on trade, whether on geopolitics, the whole world is affected. You are also seeing as much risk in other asset classes, so whether it is equity or bonds. And some consequences is that none of the markets are therefore able to react to it, right? So what do you do? So if you sell India, do you go to China? Do you go back to US? You go to Europe? And actually, if you see calendar year YTD, most of the large markets have performed in line or even better than India, right? So it's not that India is outperforming. So you look at many European markets, they are actually up 25-30%. Korea is up 30%. Initially, the narrative was that money is moving out of the US market is correcting, and therefore all these markets are going up. But US market is also back close to all-time high. So I think really the challenge is on a macro basis, liquidity in this uncertainty is not really finding any asset class, maybe except gold, that is safer, and how much money can go into gold.
Okay. So, but you also remain fully invested. You're not going to cash to sort of...
Yeah, so we have higher levels in cash today than last year, but it's not like that won't really meaningfully change the return profile.
Okay, fair enough. Nilesh, very quickly, because we're running out of time, your quick take. Do you see it as a big risk, different from what we have seen over the last 3 years?
No, markets have been fairly resilient, maybe because India macros were good. But purely on these events, despite that, I think what could have impacted the macro economic parameters in the near term would have been a spike in oil prices. But somehow that also most experts are saying that because of supply dynamics, oil prices would not shoot up as much. That could have actually impaired many of the macros things. So that's fairly resilient. Yeah.
So that is one reason the market's not reacted as
and
one
there are
would have
flows.
expected.
Flows are supportive, so let's not dilute that thing further also.
Fair enough. What's your cash strategy? Because you're the one, I think, amongst the mutual fund industry who believes in really holding a substantial portion in cash to sort of tackle with risk.
It's not linked with the macro at all, or the geopolitical thing. Wherever, Q2 result or the Q4 result season is behind us, wherever we are finding opportunities, we are deploying, and otherwise we are staying in cash. It's not linked with Iran and US war or anything of that sort.
Fair enough. So this geopolitical risk is not something that is altering your investment strategy. On that note, we've completely run out of time on this panel. Thank you so much, and thank you so much, gentlemen, for all your insights.